Bloomberg Audio Studios. Podcasts, radio, news.
Market dominance in the S&P 500 leading some investors to look elsewhere. Peter Oppenheimer at Goldman Sachs writes in this: we believe that there are many companies outside of the US that should be considered as part of a global diversified portfolio and should not be ignored simply because their base and listing location is outside of the United States. Peter Oppenheimer joins us now for more. Pete, let's get straight into this because it's a really important theme. If it's winning, even if it's dominant, should I be concerned?
Well, the short answer, John, is no. I mean, the outperformance that we've seen of the US, which has really been particularly dramatic since the financial crisis, has been entirely based on solid fundamentals. The US economy, but most importantly, profits, have simply outgrown those of other regions. But as a result of that, its valuation has risen a lot compared to other parts of the world. And now we're finally seeing a bit of a narrowing in the relative fundamentals. Actually, profits are picking up outside of the US, where the valuations are lower. And we think that the US market can still do pretty well, but there's some great opportunities outside, and diversification makes a lot of sense. And that's true at the sector and the stock level too.
Pete, we can talk about those opportunities in just a moment, but can we also discuss what we're fighting? Are we fighting passive flows that just couldn't care less?
Yeah, to a large extent. Look, passive investing has worked very well over the last decade or more in an environment of ever lower interest rates, where bigger companies are becoming increasingly dominant, and the US equity market itself has got the highest share of the world market since the early 1970s. So what's been winning has continued to win and win over time, and that's been a great environment for passive investment. We think that as interest rates stabilize at a slightly higher level, sure, they'll come down cyclically, but they won't come down structurally. Returns at the index level are going to be slightly lower, and that's an environment where the opportunity set is more attractive for active managers, and also for more differentiation and diversification, and that means across regions, across sectors and styles as well.
Peter, when you talk about the case for international, I'm curious where you're looking in particular and whether it's regional-based or sector-based, as you were just noting.
Look, it's a little bit of both. I mean, the US has done extraordinarily well, partly because it's had a very high exposure to the growth factor, principally dominated by technology, which has been the winning sector over the last decade. We still really like technology. We think that the dominant companies have been justified again in their dominance because of incredibly strong fundamentals. But we think that you've got better relative valuation opportunities outside geographically the US. And indeed, last year, rather quietly, the Euro Stoxx 50 was slightly stronger than the S&P. Many people don't acknowledge that year to date, Europe has outperformed not just the S&P, but the NASDAQ. So has Japan. So it isn't that we don't like the US. It's gone up, it's done well, but there are geographical opportunities to diversify. And I think that means also broadening out from technology. We think technology is still going to be crucially important and do well. But as interest rates come down and we get this soft landing, the opportunity for broadening out into some more cyclical parts of the market is improving, but also into non-tech companies. We put together a list of what we call ETCs, ex-tech compounders. These are global companies outside of the tech sector, which have strong characteristics of reinvestment at a high rate, compounding high returns, and they tend to be somewhat cheaper, and I think also offer good diversification opportunities.
Overnight, Peter, the Citigroup team, the equity team over there, actually upgraded EU stocks with about 6% more upside year to date in their view, and it's one of the highest in the street. This is the reason why. More certainty on rate cuts. We've been talking a lot about that. Global growth, you alluded to that, and dollar weakness. How much is dollar weakness necessary for this call to work?
Actually, I'm less convinced on the dollar weakness part of that story, although I agree with the other comments that you made. The European economy is growing at a much weaker pace than the US. We're looking at US growth this year of around 2.8%, and in Europe about 0.7%. But we shouldn't forget that the European companies that dominate the indices are very global, and therefore they benefit from a recovery in global growth and in the global manufacturing cycle, which is beginning to happen. And I think actually that what we find for European stocks is that growth trumps currency. If growth is accelerating, European companies tend to do well, even if the currency is actually stronger. Now, it may well be weaker, and that will add to its relative competitiveness. But we don't think the currency is actually the crucial part of this. It's much more about relative fundamentals, our earnings improving and those growth improving, our interest rates coming down. All of those things suggest they are. And Europe is only trading at around 13 and a half times PE compared to something like 21 in the US. The UK only trades at around 10 and a half times, about half the valuation of the US. And so there is a valuation opportunity as well, which isn't really dependent, I think, so much on currency.
Peter, when you look at India and China, you say India has good growth, China can be a value opportunity. A lot of people moved to India because they wanted to get away from China. Why do you see something interesting in both markets?
Well, I think that India is a bit of a different story. It's got high growth rates, both in terms of the corporate sector and in terms of the economy. It's a relatively expensive market, but it's one that has good exposure to long-term growth, and it is benefiting a little bit from diversification of supply chains and indeed diversification of investor focus away from China towards India. China's a bit of a different story. It is a valuation value play. I mean, the market trades at around 7 times earnings, much cheaper. Of course, it has a lot more structural headwinds and a higher risk premium given current developments. And it's much less, I think, of a consensus than India. But for a valuation-led recovery, if we get any policy stimulus, we think that there's reasonable upside, at least tactically, in that market as well.
Got to finish on Japan. Pete, it's just been amazing. Nikkei 225 year to date up by something like 22%. I think we had a move over the last year of something close to 50%. Pete, when I buy the S&P 500 market cap weighted, I know what I'm buying. I'm buying mega cap tech in a big way. When I buy Japan, Pete, what am I buying?
Well, I think there's 2 things to say about this. First of all, actually, just like the US, both Europe and Japan have seen an increased concentration by stock. So the biggest 30 companies in Japan, which are very global, are actually the biggest share of the 1,000 biggest that we've seen going back over several decades. So you are getting dominant, large cap, globally exposed companies doing very well. I think that the Japanese market is much cheaper than the US. Of course, it's gone up a lot, but we shouldn't forget it's only just broken through the level that it peaked at last in 1990. And the fundamentals are finally very different because you're getting expanding nominal GDP. We're finally coming out of the deflationary stagnation that's dominated that economy over the last 25, 30 years, but also quite a lot of restructuring stories because of bottom-up focus on improving return on investment from a low level. So with rising margins, return on equity going up, that justifies a bit more of a higher valuation. But the dominant companies there really are global companies in areas around technology, high value-added manufacturing that benefit from a bit of a pickup in global manufacturing cycle as well. And we think they're pretty well positioned, John.
Pete, always enjoy your thoughts. Thanks for being with us. Peter Oppenheimer there of Goldman Sachs on the latest.